I think ultimately the gold-silver ratio will retrace, coming out of the ground at 7-1.
Is the thought still to swap silver for gold at 40-1?
It's intervening in the free market. And anytime you do that, you create distortions. It would have to be north of $40 an ounce as a floor on silver in order to incentivize mining in the United States.
What happens to the price of the ETFs if the COMEX collapses at the end of the month?
So the question, 50 basis management fee to BlackRock and JPMorgan for nothing.
What if
everything moves eastward, which ultimately will happen? Price will be settled in places like Dubai, Shanghai, BRICS exchanges, Singapore exchanges, St. Petersburg exchange. They will set the price within our lifetime.
Fed Chair Jerome Powell was asked if he interprets this rise in precious metals with regards to the dollar and economic stability in the United States.
Here again, who's standing for delivery in all the gold that's been coming in? 2, 3, 4 million ounces every single month. I mean, it's just silly because, again, I believe that's the exchange stabilization fund.
JPMorgan is saying that they expect gold to reach $6,300 an ounce.
I wonder what the gold-silver ratio will be when the price floors are set. Any comment on that, what you think it's going to be? And if they're going to be using some of those floors for a GSR?
Again, the what if questions are impossible to answer. I mean, I don't look at the price floor as being anything other than just that, a floor. I don't think that they're going to have to do much to implement it. I think if it's allowed to trade freely, the price floors will be the least of their concerns. I think ultimately the gold-silver ratio will retrace. The further away you get from historic averages, the greater the magneticism that regresses you or pulls you back to the mean. When you realize that price has never been allowed to really be discovered in both of these metals, it's anyone's guess. But for 5,000 years, we were at a 16-1 or less ratio. And it's a relatively new phenomenon where we've digressed from that. When you add into it the ability to trade at massive leverage on a paper market that rehypothecates or sells those same contracts over and over and over and over again, and maybe we're coming to the end of it, what is the real gold-silver ratio? To assume that it would get somewhere back near its geological and its historical number of 16-1, I guess that's not crazy, is it? It's coming out of the ground at 7-1. So certainly much lower than it is right now, and which means silver is still vastly undervalued in relation to gold. And it doesn't matter how high silver goes, it just matters what is the relationship between the two.
The ratio story sounds academic until you realize it quietly determines capital flows across metals markets. As Andy Schectman points out, the historic 16-1 ratio isn't just folklore. It reflects centuries of monetary alignment between gold and silver markets. Today's ratio, hovering far above that average, signals structural distortion from leveraged derivatives markets, where paper trading volume exceeds physical supply multiples over. For investors, this isn't about predicting silver's price, but recognizing mean reversion cycles that often follow liquidity crises or monetary resets. That's exactly why Andy Schectman believes the ratio matters more than price alone.
We've talked in nauseam about the value of silver still, even in relation to the S&P and how we've done that correlation. Do you think that the government will use some type of formula to determine what those floors are, based on whether it's spot or what's happening, in Shanghai?
I would love to know how they calculate it. I mean, how do you calculate any price floor or price ceiling? It's, to Michelle's point earlier, it's intervening in the free market. And anytime you do that, you create distortions that are unintended. What will it be? I don't know. My guess is it would have to be north of $40 an ounce as a floor on silver in order to incentivize mining in the United States, because the majority of all the silver that is mined is a byproduct of lead, zinc, and copper.
Yep.
Right now, where the low-lying fruit has been plucked. So how do you go and just find more silver? You have to dig further, you have to expand, because those companies mining those metals don't have incentive to look for silver. They just stumble across it. It's going to have to be high enough to where, never see a 30 handle on silver ever again if that's what they were doing, because it would just cost too much to find it. So I don't know. I think maybe as time goes on.
We'll probably know soon enough. But
price floors in commodities rarely solve shortages. They usually expose them faster. Andy Schectman's point about mining incentives highlights a real supply economics constraint. Nearly 70% of global silver production comes as a byproduct of base metal mining, not primary silver operations. Governments can influence prices, but they cannot easily manufacture new ore deposits or reduce extraction costs. Investors should remember the 1970s commodity controls that created supply bottlenecks instead of stability. If mining economics require 40 plants silver to expand production, Andy Schectman suggests policy intervention could unintentionally accelerate scarcity.
But I agree. I mean, what you're saying about especially since most of the silver that we get is a byproduct of others, doesn't mean we're not going to mine that much more of those other metals to get silver as a byproduct. They can't just ramp up the way that they can to do that. So that's where I think most people assume we'll just get more silver. The low-hanging fruit's gone. We've gotten rid of those low-hanging fruit for silver a long, long time ago. So as Andy said, originally it came out of the ground at a 16-1. Now we're at roughly 7-1. Makes a big difference here. So, well, we have another question here. Andy, do you think that most local coin shops will be driven out of business because of the challenges with these large price fluctuations?
Yeah, sure, certainly could. I mean, you buy metal, you don't hedge as a small shop. You take in $100,000 worth of silver and it falls by 40%. How long does it take you making a few bucks a coin to build back your $40,000 loss or your $50,000 loss? And the local coin shops aren't hedging. So yeah, I think it becomes not only that, the cost of holding inventory as the price goes higher, the insurance, the all of the security risks, all of these things become magnified.
Volatility doesn't just shake investors. It restructures entire industries behind the scenes. Andy Schectman highlights a reality rarely discussed in markets. Small dealers operate without the hedging tools large firms use to survive price swings. A 40% drop in inventory value isn't theoretical. It's bankruptcy math for small businesses operating on thin margins. This mirrors consolidation patterns seen in banking after the 2008 crisis, where scale became survival. Investors often miss that infrastructure changes in metals markets signal deeper systemic shifts, something Andy Schectman warns could accelerate during sustained volatility.
So yes, I would say that it will consolidate into larger companies like ours who will dominate the marketplace because we hedge, because we have larger bank accounts, because we have the ability to transact with all the big players in the market. And it's an unfortunate reality. My guess is it will be crippling on a lot of the small coin shops. Absolutely.
Yeah. At Bluebird Hill 1 says, at what point will Miles Franklin and other silver buyers, sellers start ignoring the paper price and start selling at, quote, physical price? Shanghai is sort of moving in that direction. Any insight to that?
That's a good point, but who knows? I mean, for now, the paper price is the price here. I guess when there's no one that will accept the other end of the contract at those prices, when you try and sell short, no one's going to take the other side of it. So prices have to go higher, I guess, at some point. And again, it's a form of arbitrage. At some point, the Western paper market has to be exposed for what it is. Either that or you have two prices. You have an Eastern price and a Western price. And you're just not allowed to ship metal out of the country. And it is what it is here.
Two pricing systems for the same metal would signal a breakdown in global market trust. Andy Schectman's observation about paper versus physical pricing reflects a growing divergence already visible in regional premium differences between Western futures markets and Asian exchanges. Historically, dual pricing systems emerged during currency crises, such as the London gold pool collapse in 1968. If arbitrage stops working because physical supply tightens, futures markets lose price discovery authority. For portfolio strategy, this would shift power from financial exchanges to physical delivery hubs. Exactly the structural change Andy Schectman believes investors should watch closely.
Bottom line is that these again are very difficult questions to answer. You could sit around with a bottle of scotch and try to figure it out and solve all the problems. I don't know how easy it will be, but until otherwise noted, we're trading the price on COMEX. And
I mean,
for the big traders to buy it in the West and deliver it in the East, they're the ones taking advantage of the arbitrage. And right now, that's the price. So if that really is the case, then it would be a bigger question to ask, why aren't you buying all that you can at these prices if you know the price ultimately will be higher in the East? It already is higher in the East.
Which will bring us to our next question here, but at Tom Johnson 8460 says, is the thought still to swap silver for gold at 40 to 1? It was there briefly, then gone. No, it wasn't at 40 to 1. We never got down to 40 to 1. We got down, I think, to roughly about 47, 48. And I know, because I was standing right next to him, Andy and I were both on the phone with some of our clients, and we were advising to take some of the, peel some of that onion back, take a little bit off the table on silver, buy gold. And right now, those people that actually did so, we're still looking pretty good.
Arbitrage only exists when markets disagree on value. And that disagreement rarely lasts forever. As Andy Schectman suggests here, the West-East pricing gap hints at structural stress in global metals markets rather than simple regional demand differences. Historically, commodity arbitrage closes quickly, unless capital controls, logistics, or liquidity shortages intervene, something investors saw during the 2020 supply chain disruptions. Portfolio discipline matters here more than price forecasts, especially when ratios briefly compress like the move toward 47 to 1. That's why Andy Schectman keeps returning to ratio strategy instead of directional price predictions.
No, not one person listened to me. Not one.
Not one, really. I had a bunch that listened to me. I had a bunch. But I had some people that also, said silver's going higher. And I believe that it is going higher. But whether or not it does or it doesn't, it still is always a smart idea, in my opinion, and I know you believe the same way, to take some off the table and put some into something that is,
even if it's going higher and you're playing the ratio, it's the ratio that matters, not the price.
That's it. But
exactly no one took my advice. Everyone was waiting for it to go higher, even after I told them that.
I had a bunch of people that did actually take my advice, again, on that smaller percentage. And you know what happened is then it went to 120. And then they were saying, well, you kind of screwed me, and I could have gotten X amount of dollars more. Then 2 days later, when we were looking at $85 silver and then $80 silver, they were saying, wow, that was pretty good. And then, of course, the gold, which rebounded quite substantially, and they bought it on the cheap. They were pretty happy in doing so. So just words of wisdom. Again, it's always a smart idea to take a little bit off the table, reposition yourself when the ratio calls for it, like Andy said. Not price, but ratio.
Markets punish emotional timing far more than wrong forecasts. Andy Schectman's example captures a classic investor behavior cycle: regret during rallies and relief during corrections. Studies from Delbar consistently show retail investors underperform markets by several percentage points annually because of timing decisions rather than asset selection. Rotating between assets when ratios stretch is risk management, not market timing, especially during volatile commodity cycles. Investors who rebalance during strength preserve capital for downturns. A discipline Andy Schectman repeatedly emphasizes when discussing precious metal portfolio strategy.
What happens to the price of the ETFs if the COMEX collapses at the end of the month?
Well, I mean, let's hope that I don't think the COMEX is going to collapse at the end of the month. The ETFs are a direct function of the Western paper price. So, I mean, if anything, it would go parabolic, but the thing would probably shut down long before that would happen. It's a tough question to answer, simply to say that as far as I'm concerned, stay away from the ETFs, and you don't have to worry about that question by the physical. You're paying a 50 basis management fee to BlackRock and JPMorgan for nothing.
Which you could do in one of our depositories for less. But I guess that serves as a good question. What if hypothetically, March comes along and it's a big contract month, and instead of 20%, what if 40 or 50% do stand for delivery, and we don't have the COMEX doesn't have that metal? What do you think happens?
Force majeure, cash settlement, which is the same thing as a default, and it is the beginning of the end for the Western system.
ETF liquidity feels permanent until a delivery crisis tests the structure underneath. Andy Schectman points to a scenario markets rarely price in: futures contracts demanding physical settlement beyond available inventory. During the 2020 oil futures collapse, contract mechanics mattered more than commodity fundamentals, reminding investors how financial instruments can detach from real supply. ETFs track paper pricing mechanisms, not necessarily physical availability, which creates hidden counterparty risk during stress events. It's a structural vulnerability Andy Schectman believes investors underestimate when assuming exchange-traded metals always reflect physical reality.
Everything moves eastward, which ultimately will happen. Price
So
will,
if
in
in
our
fact,
lifetime, price will be settled in places like Dubai, in Shanghai, the BRICS exchanges, the Singapore exchanges, the St. Petersburg exchange. They will set the price within our lifetime, I do believe, if we're not careful, because we are losing credibility rapidly.
And it's interesting you bring that up, because we've talked a lot about silver so far, but we haven't really touched on gold. And gold on that fateful January 30th day also had about a 10% drop, which is unusual for the gold market to move like that. And it's curious that a couple of things happened before this drop in gold and after the drop in gold. And one of the things that happened before the drop in gold, you were talking about credibility and you're talking about the Fed, was that Fed Chair Jerome Powell was asked how he interprets this rise in precious metals with regards to the dollar and economic stability in the United States. And here's what he had to say about that. We'll play that, and then we'll also point out that right after this comment, we had this tank in gold and in silver.
Global price discovery is slowly shifting toward regions accumulating physical commodities, not financial derivatives. As Andy Schectman implies, the rise of BRICS-aligned exchanges reflects broader capital flow changes driven by central bank gold purchases, which exceeded 1,000 tons globally in recent years. A sudden 10% gold drop around January 30th highlights how sensitive metals remain to policy messaging and liquidity shifts. Investors should watch where physical settlement volume grows, not just futures market headlines. That geographic shift in pricing power is exactly what Andy Schectman believes could redefine commodity markets over time.
Let's take a listen.
I'm sure you've noticed gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
And a few days after that, gold tanked. This announcement of Kevin Warsh comes out. What are your thoughts on that and what we heard from Powell?
You want to go first, Dan? You go first.
I think that all the central banks and central bankers, him included, know that the debt that we have cannot be repaid through productivity anytime soon, which is why they've all been buying record amounts of gold and repatriating reserves.
When central banks dismiss gold signals while simultaneously buying it, the contradiction speaks louder than policy statements. Andy Schectman highlights that central bank gold purchases exceeded 1,000 tons annually in recent years, even as officials publicly downplay inflation credibility concerns. The Federal Reserve's messaging after the December 2025 FOMC meeting emphasized anchored expectations, yet sovereign debt levels above $34 trillion tell a different story about long-term repayment risks. Investors should notice actions over rhetoric, because reserve repatriation historically signals monetary distrust beneath the surface. Andy Schectman returns to this contradiction next when discussing who is quietly accumulating supply.
And decades of this price suppression plus trillions of new dollars mean, precious metals are just getting started. And I think he understands this. And I think that he is trying to mitigate the way that this all plays out. There's no coincidence that he said this, and I think right before a big price smash. But they're very, very cognizant of it, because here again, who's standing for delivery in all the gold that's been coming in? Massive amounts, 2, 3, 4 million ounces every single month. I mean, it's just silly, because again, I believe that's the exchange stabilization fund. They can't be forthright about what they're saying. The central bankers know it. They've been standing for delivery forever. But now that someone here in the United States is doing the same thing, and I think it's probably the exchange stabilization fund or the big banks who know what's coming, they can't be forthright and honest about it. It sends the wrong message. Even if he is not being genuine, I don't think he has any choice but to say that. I would argue he feels 100% differently.
Price suppression debates matter less than the delivery data quietly building in the background. Andy Schectman often points to monthly physical delivery requests of roughly 2 to 4 million ounces as a structural signal that paper pricing and physical demand are diverging. Since the 2020 liquidity crisis, global money supply expansion has exceeded $20 trillion across major economies, creating persistent currency debasement pressure. If stabilization funds or major banks are accumulating metal, it suggests institutional hedging against monetary instability rather than speculation. Investors should watch delivery trends more closely than daily price swings. Andy Schectman next connects this delivery behavior to investor psychology shifts.
Now, are they happy that the price got knocked down, cleaning out the flushing the speculators, making people think that, yeah, maybe it isn't the refuge, maybe we should look elsewhere, maybe we should buy bonds, etc. Sure he is, but it just falls right into the hands of those that are standing for delivery every single month, this month included, next month included. It isn't stopping, and the people at that level know what's coming, and you can see by their actions how they really feel, not by the rhetoric that we hear from Powell.
And gold bounced back very quickly, and I will have you know that JPMorgan is saying that they expect gold to reach $6,300 an ounce by Q4 of 2026.
Yeah.
UBS raising the price target to $6,200 for March, June, and September of 2026. Goldman Sachs raising, they're a bit more modest. They're raising their price forecast to $5,400 per ounce. But we had these comments. We had a gold sell-off. I want to get Kevin's thoughts on some price moves before I bring up another big development in the gold market.
Short-term price drops often serve institutions better than long-term investors realize. Andy Schectman notes that physical buyers frequently accumulate during volatility spikes, while retail investors rotate back into bonds when yields briefly rise above 4.5%. The quick rebound after the sell-off reflects strong underlying demand, especially with banks like JPMorgan projecting gold near $6,300 by Q4 2026. Historically, sharp corrections during commodity bull cycles, like 2006 and 2009, often preceded major upward moves rather than signaling collapse. Portfolio discipline matters more than reacting to temporary price shocks. Andy Schectman next explains why institutional forecasts tend to lag real market positioning.
So, Kevin,
Yeah.
you're hearing these price forecasts from the big banks.
Yeah, I always find it amusing that these banks forecast higher levels once we've hit past their existing targets. I think the only one that I've seen was it Macquarie? I think bank had one of the targets at like 4,700 by year end, which that's great. We're already trading above it. I think
JPMorgan is saying 6,300 by Q4
Yeah.
2026.
which is, again, I mean, that's my target was roughly on gold ending the year around 63 to 6,500. So I'm in line with that. And I think that when we look at, demand from the industrial side of silver, when we look at gold, I mean, really there's been two countries, China and India, has been a force, especially in retail, that has been so behind the gold buying. And we're not seeing that let up in any way, shape, or form right now. So we just had global bar and coin demand at a 12-year high to almost 1,375 tons. So, I mean, you're talking about close to $154 billion. This is not something that's ending anytime soon. And I think because of that, we're going to see a substantially higher price going into the year end. And I think JPMorgan's going to be right, around that price level.
Well, the fundamentals for gold are certainly still there, very much so. And as we know, central bank purchasing has been on record levels, and there's only indications that that will continue. I do want to bring up another angle regarding China, but I'm going to let you get some more questions from the viewers before we touch on that.
Yeah, let's get a couple of these questions, Michelle. And by the way, not just industrial and central bank demand for gold. I mean, the retail demand in a lot of these countries has been nonstop as well. So
bank forecasts tend to follow price momentum rather than predict it, which explains why targets rise after rallies. Andy Schectman frequently emphasizes that global bar and coin demand reaching about 1,375 tons, a 12-year high, signals retail conviction in Asia, particularly from China and India. This demand strength coincides with central bank buying streaks that began accelerating in 2022 after sanctions reshaped reserve strategy worldwide, when retail, sovereign, and industrial demand align simultaneously. Commodity cycles historically extend longer than analysts expect. Long-term investors should focus on demand structure rather than headline price targets.